This morning or higher. Take a look. We are about an hour away from the opening bell for a Thursday. Dow Industrials right now up 41, the S&P up 15, and the Nasdaq higher by 63. Investors are weighing market valuation concerns and growing volatility in AI stocks. Top bank CEOs also warning of a potential market correction as big short investor Michael Burry reveals he is betting against the AI boom, in particular Palantir and NVIDIA. Joining me right now is the Miller Family Office Portfolio Manager, John Spallanzani, with us here on these markets. John, great to see you.
Hey, good seeing you again.
Thank you so much for being here. So what are you looking?
Really quick, if you guys don't know who Michael Burry is, he was one of the guys who shorted the market in the 2007, 2008 financial crisis. He basically bet against the housing market. Very few people knew that this bubble was actually happening. He saw that defaults were on the rise, and he took that data. He said, hey, if this gets over, I think that the number at that point was like 8% of defaults, there was going to be a collapse. We're seeing similar numbers in like the auto industry right now in terms of defaults. I don't know exactly what the housing, but I know foreclosures are all obviously up. But Michael Burry is famous for shorting the housing market. So if you guys want to know more information, definitely not a plug for this movie. You can watch it, I think, anytime on YouTube. The Big Short actually explains everything about that bubble and what happened.
Looking at as most important in terms of driving your decisions on your portfolio, on the Miller portfolio?
Well, I think we don't do a lot of trading, as you know. Our biggest positions are obviously Amazon, Bitcoin, Clear Secure, which reported this morning, had a good quarter, and obviously some legacy Googles, Metas, that kind of thing. But you know, right now it's very interesting markets, right? You have Michael Burry saying he's buying puts. You have some CEOs warning about bubble trouble. You have people worrying about lots of different things. SCOTUS obviously on the forefront right now with the decision about tariffs. We had Challenger came out this morning, layoffs the highest in 20 years, which I thought was a big number, especially because it's coming from technology, which is AI affected, as well as warehousing, which is robotics. So we have these two big mega trends, AI, robotics, drones, all that kind of stuff, kind of taking over the world right now, as well as the U.S. And there's this arms race, really, for technology. And the technology arms race is driving all the data centers, all the chips, all the demand, where people are putting, you know, $1.5 trillion, $3 trillion, you know, huge numbers on what the CapEx is going to be. And
when technology starts to move the way it is right now, in my opinion, there has to be a correction, right? I think we saw this back in the .com days where all these websites just started just popping everywhere, money's flowing. I was a little young at this time, didn't understand what was really going on, but you definitely heard about it. And these websites, you know, gained a lot of investment, a lot of capital investment inside of these new companies, these .com companies. And then one day, I think it was just over leverage and there was a huge collapse. Now, I think we're seeing the same thing happen right now with tech companies. With all the AI that is being generated and being produced and taking over real jobs, we're starting to see the same type of push. And I think eventually everyone thinks that this market is unstoppable. And I think, you know, when you get such an exciting new technology that is going to really replace workers and jobs, and we also all know that the market loved that, right? They love the sound of layoffs because that meant more revenue back for these companies. But that's what it looks like right before the bubble bursts, right? It looks like a lot of energy, a lot of like mass adoption happening so quickly, and then overnight it pops, right? Because it's really not growing. In my opinion, it's really not growing naturally. It is, but it's just happening too fast, right? These markets and the amount of money that's coming into them, it's too rapid, right? And when you get this rapid increase in tech, as we've seen, right, tech can grow, but it also can't scale back with the best of them, right? We're starting to see that in the job market. They don't need the developers and the engineers and all these folks. So you're seeing now tech companies really start to withdraw. So What's going to be the bubble bursting? I don't know. What's going to cause it to burst? I don't know. But we're seeing that a lot of these companies are really over leveraging themselves. And I think that's what's going to be the cause of the pullback. But we'll kind of finish with this video, kind of go on from there.
You see that really, Mag 7 is obviously where all the money is going, but the revenues are there. Their revenues increase because of the capex that's going. Capex per revenue per share has been really ramping up. So earnings have been actually better than expected, than a lot of people expected. So we had a valuation-driven market last year, and this year we're starting to see the earnings. And we also have the big beautiful bill that really hasn't even hit yet, because we're going to see a lot of tax breaks coming in the early part of next year. We have a
So he just talked about these earnings, right? And when you have earnings like this that are coming from these huge valuations, and obviously the money starting to come in, what it's doing is it's kind of contradicting itself, right? It's a lot of layoffs happening, but there's a lot of money being made, right? And these are like 50 to 100 times its current revenue, revenue producing money, cash that's coming in, right? And we've seen this with the dot-com bubble. We saw it with crypto, right? And now we're seeing it with AI. That again, despite the layoffs, despite all these like signals, this bubble is growing, and it's growing, and how much longer it grows, we don't know. But the warning signs are there, right? The warning signs are there. Tokens are exploding, just like the ETFs are exploding. But layoffs are happening, and they're going to continue to happen. And here's the biggest problem. This is where I think that most people are going to be hurt. See, a lot of your 401ks, and this is how most people get, really blindsided by this collapse. I mean, everyone sees their 401ks going up. They're like, oh my gosh, my 401k is making money. Let's put more money aside in NVIDIA. Let's put more money aside of Palantir, like these massive companies. And every time there's been a collapse, these are some of the companies that have the biggest downturns, right? And so I try not to get so excited about some of these things when you see all this money being made, because you got to remember, the investors that actually really are making money, they make money on both sides, right? See, they're making money on the way up, but they're also positioning themselves, just like Michael Burry, they're also positioning themselves on the way down. So if you start to see them kind of cash out, you start to hear people like, oh, the CEO sold this stock and this person sold that stock. They're saying to you within their bubble, like, hey, we know that a correction is happening, and we don't want to lose that money. Matter of fact, we're going to bet against the market, because this is what they do too. They'll bet against the market right before it collapses, just like Michael Burry. Remember, he put $1 billion. That's a lot of money to be betting against the market. So how soon is that going to happen? It can happen within 2-3 months. But if you start seeing that, those are warning signs. Like, alarms should be going off in your head. If you're investing in some of these companies, these are warning signs for you to maybe start to reposition yourself and think about other investments.
Client Fed will say, where they are in an easy mode. So that's positive as well. But again, we're all flying blind because we don't have a lot of data. So that's why we have to have anecdotal data like we had this morning with Challenger, Greg.
Yeah, I want to get back to the Challenger cuts. Most October layoffs in over 20 years. But let me stay on this Supreme Court hearing and the arguments on President Trump's tariff authority. Get your take there. If, in fact, the SCOTUS goes against President Trump, Jameson Greer just joined me and talked a bit about some of the backup plans and the fact that a lot of the tariffs put in place already are not even part of this SCOTUS hearing. But if we actually do see the Supreme Court hearing arguments and result in going against the president, do you expect that there will be a market sell-off? Will investors react to that?
Heck yeah. The market fell off when he announced it. The market will sell off if there's a reversal. Now, I don't think there's going to be a reversal. I think the Supreme Court is going to rule in his favor. They've done that several times so far. I don't think this is anything different. I think we still need to see more and more data about the tariffs and how they are really going to help or not help the society. I think that there's just too short of time right now that really hasn't been giving us enough like good data to say, okay, this is a bad idea, right? The way I explain tariffs to people is this, right? Let's say you threw a party right at your house, right? And you were terrible at throwing parties, but you got someone to say, you know what? Hey, can you help promote this party? Can you bring in all the people? You bring in the food, the drinks, the DJ, blah blah blah. And they're like, cool, we're gonna do this at your house, but guess what? I'm not gonna give you any money, right? So they brought in all the folks, they brought in the people, they brought in the food. You provided the location, right? But they made the money at the door. They made the money on the drinks, right? And they got up out of there and they left you holding the bag and you got to do all the cleanup, right? That's exactly where I feel like America has been taken advantage of over many, many years. Now, what he did though is he upset the corporate, infrastructure, because you had a lot of companies, and this is true, go overseas, mass produce all these items, and sell it back to America because they knew that they didn't have to pay taxes on that import. Right? That's why you have so many people upset. Really, that's really the reason why you got so many people upset about tariffs, right? So if I'm an American company, I know that the regulations, the taxes are high for me to produce and manufacture. I'm going to take it over to China or India. I'm going to do it at a lower cost. I don't have to pay people. I don't have to have, all the labor and the union, all that stuff that we have to deal with over here. And I'm going to sell it. I'm going to manufacture for cheap. I'm going to sell it back to America for top dollar. And that's why we've seen companies, evaluations just go through the roof because they're able to, produce it at a cheap cost and sell at the highest bidder. I mean, it's really good business at the end of the day, especially if the laws are allowing you to do that. But when someone comes in and changes the law and they say, hey, you know what? We got to put time out. Boop, boop, boop. Blow that whistle. Right? Blow that whistle. We can't keep doing this because what you're doing now, all those jobs that could have been here in America are overseas. That's why we don't manufacture anything. Right? America has been a consumer nation. And when we started to take jobs overseas, right? And then got people thinking about other type of jobs. We got into tech. So see, now we're kind of stuck in a really bad place because people aren't doing services, which is the reason why I think immigration has been what it is, because now those people are coming in and doing all the service jobs. But then now, if you aren't in tech, if you're not in healthcare, if you're not in some of these careers that really pay you money, you're kind of stuck in the middle. You're not doing the service jobs because you think you're too good for it, and you're not good enough. You don't have any degrees or the skills to do any of those other type of jobs, those tech jobs, right? And so you got a lot of people stuck in the middle in that retail sector or working for the Amazons, the UPSs, all these companies that are laying off the average people, right? So we have to get back to manufacturing and we have to get back to skilled labor. Last thing I'll say, in terms of the protection of your assets in this regard, going back to our initial conversation around this bubble, I think it's a really good time to start looking at other sectors, healthcare, fixed income assets, consumer staples, right? Be honest, like during the pandemic, alcohol sales are on the rise. Typically, you get some type of collapse or economic recession or depression, alcohol sales are going to go through the roof. I'll say another one to look out for is rare earths. I know U.S. and China have been doing a lot on the back end in terms of negotiations, but I think what's happening now is you're starting to see the U.S. partner with other companies. So there's going to be a big push for rare earth minerals to be mass produced and not at the hands of just China, which kind of controls everything. With these partnerships we have with Japan, Australia, and I think a couple of other countries, that's going to be an opportunity for American companies for sure to take advantage of. All right. Hey, we're going to keep bringing you this news daily. I'm committed to growing this channel. I appreciate you guys. Remember, stay safe, stay strong, invest wisely, and keep saving America's money. Talk to y'all. Peace.